Steve?
John, thank you. And welcome, Jim, to the virtual Jackson Hole Summit, which is how we're doing everything these days. Thanks for joining us.
President Happy Bullard, to be here.
Let me start off with the thing that John was just talking about, which is that you released the average inflation targeting change yesterday, which we all expected in September. So I'm wondering, is that it for September, or should we be sitting here bracing for something else, an actual policy move for the Fed come next month?
Yeah, well, we'll have to wait for the September meeting. And obviously, we're in the middle of a crisis here, so lots of data can come in, and we'll play our cards at that point and make a decision there. I think the chair did a good thing here by using the Jackson Hole Summit to announce the closing of the framework review. This has been going on for 18 months. We did intend to close it earlier this year. Couldn't do it because of the pandemic. Makes a lot of sense. He was able to give a fairly long speech explaining the changes that have been made, and I thought it came off pretty well.
Let me get your sense of how that might work in practice. When we talk about letting inflation run above 2% or averaging out to 2% over time, what's your tolerance for inflation to run? Is it 2, 2.5%, 3%?
Yeah, inflation has run below target, certainly by 0.5% for quite a while. So it seems like you could run above for 0.5% for quite a while. The idea here is to cement inflation expectations at the 2% target, because you really want that credibility all the time. That's a key aspect of central banking. And I think that this lower bound, or the zero lower bound, is kind of dragging average inflation down over time. That's certainly happened in Japan. It's happened in Europe. We don't want that to happen here. So we want to be sure that we can cement inflation expectations at 2% by actually hitting 2% on average over time.
I want to return to the current state of the economy, President Bullard. Let's talk about what you're seeing right now. We've had the resurgence of the virus. Are you seeing a knock-on effect in terms of the recovery of the economy?
I think we're continuing to expand here. This will be one of the best quarters ever for economic growth in the U.S. Makes perfect sense. You're coming off the very negative second quarter. I think you're getting the disease under better and better control every day. Businesses are learning how to adapt and how to get their revenue streams back up to where they were. Some businesses actually doing better. Obviously, some are hit very hard, but you'd expect that kind of uneven reaction to the crisis across the industrial sectors. So I think we'll grow really rapidly here in the third quarter. 20+%. Some tracking forecasts are 25% at an annual rate or higher, and then I think you'll continue to grow in the fourth quarter and first quarter. So I think we're in the recovery phase here. I think the recession was only 2 months, even though it was very sharp.
Jim, how critical to your outlook and that very optimistic view, I don't know if it's optimistic, but it's a good one, it's a good view, to the economy, how critical to your outlook is an additional fiscal package? Do you think that's needed? And if you don't get it, is that something the Fed has to offset?
Yeah, I don't know what's going to happen on that, but I will say this, macro forecasts right now, a lot of Wall Street are, they're projecting national income will be down about 5% in 2020 compared to what it was in 2019. And if you look at the CARES Act and the other bills that were passed earlier this year, they amount to at least 10% of GDP. Some people would even say 14% of GDP. So it depends a little bit on how you count these things, but it seems like there are quite a bit of resources in the pipeline already. A lot of that has actually been saved by households, because I think some households just can't spend on the same kinds of things that they would have spent on previously. So, and then you've got the executive order, whatever you think about the executive orders helping out on the unemployment insurance and elsewhere. So it's not clear to me that the incentives are quite as strong as they appeared to be a couple weeks ago for both sides to come to a deal. So may not see that, but on the other hand, I think there are plenty of resources out there.